I want to ask you a question about holding risky assets, because we've been through more than a decade of central bank printing and buying those assets after the global financial crisis. And you've been talking increasingly about the fact that the forward expected return of assets holding them today and looking out over a decade is essentially around zero, maybe very little. But then investors will still have to contend with the volatility of owning those risky assets. Can you flesh out this concept for our listeners?
Well, what I mean is we know where interest rates are. You know that if you take a 10-year bond, you know what your return is going to be on that 10-year bond. And if you then do calculations of what is the expected returns of other asset classes, start off as you deal with each of those companies that are borrowing, and you look at what their interest rate is, and then you look at their equity expected return relative to their interest rate based on the present value of the discounted cash flows, that all asset classes, and that includes private equity, it includes venture capital and so on, have very low expected returns, meaning that if you were to just hold them over the next 10 years, they're all going to have not nearly enough return, and they're going to be low. So that's a fact of life. We also know that asset classes are affected by monetary policy. So when they lowered the interest rates and did a number of other things in the past, that allowed asset prices to rise. We know a number of those things won't be able to happen in the future. So if we start to take a picture of that, we know that, in fact, you can go to maybe negative returns. And it's all happening because it needs to happen from an economic point of view. It needs to happen because there's a lot of debt and a lot of liabilities, pension liabilities, healthcare liabilities, insurance company liabilities, and so on, that are coming at us that can't be funded. So they need more returns. And so we've been in an environment where there's been a leveraging up of those returns. So because all that liquidity has been put in by the central bank because it needed to be stimulative in a no interest rate environment, we have all that liquidity looking through all the nooks and crannies of all asset classes, driving their prices up relative to their expected returns, and therefore their expected returns are going to be low. Okay, so that's a reality. Then we know that we're going to have volatility around that. You have volatility caused by the sorts of things that we've seen. Some of those things, if you have a downturn in the economy due to the virus, a lot of uncertainty about the virus, it has economic implications. And then you have a new world in monetary policy. That new world in monetary policy means that no longer is there the allocation of capital in the ways that we were used to it. In the old days, what would happen, this capitalist system, is central banks would put on deposit cash, and then bankers would come along and think about borrowing that cash and lending it to institutions or people that will pay back and that they'll make a positive spread on, and the free market made the allocation of those capital. Much less so today. Today, the markets are driven by central bankers and central governments deciding that they're going to put money in. So, and how they do that and the reactions are producing and will continue to produce volatility. It's very much like the war years, but that allocation of capital and how that is operating will create volatility. We see volatility, and so you have to deal with that volatility. But that is the character of the environment, so that the environment, it's a reality, right? Does anybody disagree that the returns of asset classes will be low from just an expected return point of view, and that monetary policy, and which is now buy financial assets and so on and print money, will be a lever that's going to have an effect on that. And so we're going to get volatility, and we have a high amount of uncertainty in that environment. So that has implications. If we agree on that, that's a fact of life, right? Can we agree on that we're going to have low returns, inadequate returns generally relative to needs with a lot of volatility around them? Can we agree that's a fact of life? I think it is. And then the question is, how do you approach it from an investment point of view?
So let's talk about that. The picture you're painting, Ray, is one where the excess returns from assets is going to be very low with a lot of volatility, as you just said. And you have always said that holding a lot of beta, well-diversified beta, is important because you can have a high probability of getting risk premiums and therefore generating returns. It's just how the capitalist system works. But it sounds like going forward, that's not so certain, and that's not likely to work over the next decade or so. Is that correct?
Well, let me describe it this way. Achieving balance, which means diversification, is more important than ever, though it will have a lower return than before. So do you want an asset class return, or do you want a portfolio of well-balanced assets? So when I look at that, I'm saying, let's say if you take a 60-40 stock bond mix, or if you take equities, or you take any one of those things, no. I think the most important thing is to start with diversifying well. Diversification of asset classes, diversification of countries, diversification of currencies, diversification, because I think that the one thing we know is that we don't know a lot, and it's not easy to necessarily time it about what is going to happen, right? So we should be given humility, and because the markets are relatively efficient in making those comparisons, it's not like one thing is necessarily better than the other, as much as we do know that some things are better diversifiers than other things to produce whatever that excess return is, that it is as stable as possible and least risky as possible to try to achieve balance. So as we look forward, what we can say is the excess returns will be lower, the premiums are lower, but it still is better to have that diversified portfolio. It'll be a lower excess return, but it still means more stable because the individual items that make up will all have low returns, but the combination of them will make it more stable.